Hi, I am Soumya Jain. Welcome to Weekly Economic Insights, where we discuss the latest news and updates that affect your personal finances. In today's segments, we'll begin with the experts' view on the recent budget and its implication. The recent Union Budget 2024 has sparked discussions about its impact on personal finances. Let's check in our expert take section to see what are experts' view and expectation from the economy after the Union Budget. Joining us is Amit Trivedi, co-founder and educator at Osat Knowledge Pvt. Limited.
Thank you very much for inviting me for this section related to Union Budget 2024. Almost every time this question is asked, now that the budget is presented in the parliament, what next? And the answer is nothing. That's the only correct answer. Get back to daily work, get back to business. Because how many cases a parent would reconsider sending the son or daughter to a college simply because long-term capital gains tax has been tweaked in the budget? How often will you change your plans to go for that vacation simply because GST has been increased or decreased? Well, if we don't change the life's plans, our financial goals do not change. And when the financial goals do not change, our plans should not change. Somebody may say that, yeah, but my money in hand would go down because the tax rates have been increased. Well, that's a correct logic, correct way of looking at it. But what can you do about it? Calculation that you did about how much you need to invest on a regular basis to be able to fund that future financial goal had lot of assumptions. First of all, the goal itself was an assumption in many cases. Number two, the value of money required at that time adjusted for inflation means the inflation also was an assumption. Then you also assume the rate of return on the investment portfolio and the tax thereon. Now, out of all these assumptions, one has changed. All you can do is do the math again, keeping all the assumptions as it is, and then you arrive at the deficit, and then there are only two options. Either you bring down the goal value or increase your savings. There's nothing else that one can do about the Union Budget proposals. Now, this question about what will happen in the next 6 months is an impossible thing to predict. Short term, anyway, is extremely difficult, and most experts have also failed at that. So in that case, most commoners would be better off not predicting, rather preparing for various outcomes. Because the Union Budget is presented to meet the objectives of the Union government, and their objectives may not be aligned with our objectives at family level or at an individual level. So if that's the case, let's focus on our own budget, our financial situation, our financial goals, and consider the budget as a non-event and blank out all the noise. That would make the life peaceful, comfortable, and manageable. That would make the finances peaceful, comfortable, and manageable.
Thank you for sharing your post-budget insights. Moving on to economic survey on mis-selling insurance and banking. The economic survey presented in Parliament on July 22nd has called out widespread mis-selling in the insurance and banking sector. The report, authored by Chief Economic Advisor V. Anantha Nageswaran, urges financial firms to focus on customer interest and avoid pursuing short-term profits at clients' expense. It notes that over 50% of complaints against life insurers involve unfair business practices, while 66% of complaints against general insurers related to claim issues. The survey criticizes soft touch regulations, stating they have rarely worked in delivering customer satisfaction. It also emphasizes the need for prompt and reasonable settlement of insurance claims to increase insurance penetration, which declined in FY23. This scrutiny may lead to stricter regulations, potentially improving customer protection and reducing losses from unsuitable financial products. This could enhance investor confidence in the long run. Now let's discuss the concerns raised by financial regulators. The booming stock market has caught the attention of small investors, with 42 lakh new Demat accounts created in June 2024 alone. Mutual funds collected Rs 15,227 crore from new fund offerings in the same month. This shift of household savings from banks to mutual funds has worried both SEBI and RBI. SEBI chief Madhvi Puri Bhuj expressed concern about speculative activities in the future and the options markets. Meanwhile, RBI Governor Shaktikant Das highlighted the impact on the banking sector, as deposit growth of 12.8% in FY24 lags behind credit growth of 16.4%. This difference could lead to higher interest rate or reduced bank profits. While this trend might increase individual investment returns, it raises market volatility and liquidity concerns. Investors should be cautious and diversify their portfolios. Moving on to the popularity of thematic fund. Thematic and sectorial funds have seen a surge in popularity, accounting for 42% of all active mutual fund flows in 2024. These funds have attracted Rs 70,000 crores since the beginning of the year, with manufacturing funds taking 28%, that is Rs 19,500 crores, and infrastructure fund 8%, that is Rs 5,900 crores of these inflows. The asset under management for manufacturing funds have grown from Rs 7,700 crores at the start of the year 2024 to Rs 32,200 crores by June 2024, while infrastructure funds have expanded from Rs 19,700 crores to Rs 32,300 crores within the same period. This trend has created high demand for certain stocks, potentially inflating their prices. Meanwhile, small cap funds are losing market share for the first time since 2021, currently at 16%. This trend offers diversification opportunities but also signals a typical bull market behavior. Investors should be cautious of potential overvaluation in popular sectors. Now let's examine the new regulations for domestic money transfer. The Reserve Bank of India has introduced stricter regulations for bank cash payout services effective November 1st. These new rules aims to counter online fraud and money laundering. Banks must now maintain recipients' record for cash payouts and register senders using verified mobile numbers and self-certified documents for cash pay-ins. Every transaction will require an additional factor of authentication. The RBI has also mandated that the payer's details should be included in transaction messages. These changes apply to various money transfer services but excludes card-to-card transfer. While these regulations may complicate money transfers and potentially cause some inconvenience, they ultimately aims to enhance security and transparency in financial transactions, benefiting investors in the long run. Lastly, let's look at the changes in TDS rates. The government has announced reduction in TDS, that is tax deducted at source rates, for various payments effective October 1st, 2024. Notable changes include reducing TDS on life insurance policy payments from 5% to 2%, commission on lottery ticket sales from 5% to 2%, and payments by e-commerce operators to participants from 1% to 0.1%. These reductions aims to simplify tax compliance and improve the ease of doing businesses. However, TDS rates for several categories include salary, virtual digital assets, and payments to non-residents remain unchanged. These changes will result in less tax deducted at source for various transactions, potentially improving investors' cash flow. However, it's important to note that this doesn't change the overall tax liability. That's a wrap for this week's Economic Insight. We have explored major shifts across various sectors, reminding us just how dynamic the financial landscape can be. Stay informed to navigate these changes and make informed decisions about your financial future.